Investors looking to benefit from the Fed's rate-cutting cycle may want to consider stocks in a long-suffering corner of the market, small caps. U.S. small-cap stocks rallied in September after the Fed cut interest rates for the first time in over 4 years. Now the question is, are these gains here to stay, or is it too early for a rebound for stocks in one of the most speculated corners of the market? Small caps are publicly listed companies whose market capitalization is between $250 million and $2 billion. Two of the benchmarks that track small caps are the Russell 2000 Index, which makes up the smallest 2,000 US listed companies included in the Russell 3000 Index. Another one is the S&P Small Cap 600 Index, which measures the performance of 600 smaller-sized companies. Small caps can grow very fast, but at the same time could bring more risks and volatilities to your portfolios. That is because small-cap companies have more debts than their large-cap peers, especially floating-rate debts, which means the borrowing costs could change over time. That makes small-cap companies more vulnerable to any changes in interest rate or the state of the economy. For example, in 2023, the Russell 2000 Index underperformed the S&P 500 Index because the Fed set the interest rate at a 23-year high. But that has started to change this year. In 2024, investors are betting on a big comeback for small caps, with the hopes that the Fed is going to continue cutting rates into 2025 and the economy is headed to a soft landing. So what can history tell us? It's notable how small-cap stocks tend to outperform the broader market or the S&P 500 in the weeks leading up to the Fed's first rate cut. For example, on average, the S&P 600 Index rose 0.8% in the week ahead of the initial Fed rate cut, dating back to 1990, compared to just 0.2% advance for the S&P 500. And a month after the Fed's first rate cut, we also see small caps outpacing the broader market or the S&P 500, with an average gain of 3.1% versus just 2.3% for the S&P 500. But when we look at the long term, it's a different story. For example, in the year after the Fed's rate cut in 2001, the S&P 600 Index rose around 10% compared to a 10% slump for the S&P 500. And in the year after the Fed started easing in 2019, the S&P 600 fell around 10% compared to an almost 10% rise for the S&P 500. So there's no clear pattern as to how small caps tend to perform long-term wise after the Fed's first rate cut. So is now a good time for investors to invest in small caps? Yes and no. Even though the Fed is widely expected to continue cutting rates into 2025, the size of the reduction is still anyone's guess. The state of the US economy is another piece of the puzzle. Even though the labor market still remains pretty strong, cracks have started to emerge in certain areas of the economy, particularly among consumers. As a result, investors may want to see solid economic growth and strong corporate earnings in order to truly get on board a small cap trade.